Hello traders, Gary Wagner here, just after 11 o'clock in Honolulu, 4 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is December 16th, 2016, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have seen. Although gold is closing higher on the day, up about $6 at 1135.50. We did see gold continue its dramatic decline this week, losing approximately 2% in value this week alone, and now for the sixth consecutive week, in other words, ever since the presidential election, we have seen gold pricing lower week upon week for, as I said, the last 6 weeks. The low that it traded to today was 1128 with a high of 1143. So we are seeing somewhat of an increased range, but nonetheless, this higher close does not take away from the overall decline witnessed this week. So traders, the first chart that I do want to look at on today's show is a daily chart. It's a standard bar chart of gold. We can clearly see that although today's action, represented by this green line right here, represents a higher close, market closing up roughly $6 on the day, we certainly saw the market decline overall this week, going to a new low, and that low not seen since February, really, of this year. So we are at a 10-month low. There's no doubt about that. This upside spike, of course, in reaction to the seizing of a U.S. drone by the Chinese in international waters. Whether or not that flares up next week is to be determined. However, I do believe, all things being equal, we could easily see continued pressure in the market, and my target right now continues to be this 78% retracement of the yearly range that we saw, in which the market moved approximately from 1050 up to 1380. We clearly broke hard below the 61% retracement, and I believe that anywhere between 75 and 78% retracement should be where this market finds support. And that, of course, is on a technical basis, and that's based upon the fact that we are in what I believe to be a B wave, and that B wave is typically between 50 and 75% that of your A wave. The A wave, of course, is this upside wave right here, and so we would look for this retracement, of course, to be anywhere between 50 and 75%. We certainly have exceeded 50%, exceeded 61%, and as I said, I believe we could see lower pricing, and my target remains somewhere between, I'll call it 1110 and 1120. We are looking at a weekly chart of the moves in gold. This is in candlestick format, and on this chart we can clearly see the decline and consistent and consecutive lower closes in gold prices week after week ever since the presidential election was held on November the 8th. Of course, this particular candle and this spike up here was just following election results as they began to unfold, and it became clear that Hillary Clinton didn't have a lock on the election, and there was a possibility, of course, of Donald Trump actually becoming elected as our 45th president. That moved the market up roughly $50 higher intranight, I should say, rather than intraday, because it happened in the evening session. And by the morning, the market sentiment really turned on a dime, pushing gold dramatically lower and equities dramatically higher. Of course, equities were trading off about 800 points in the futures markets that evening. You can see that this decline has continued, and we also see a pretty sizable decline this week by the size of this candle here. And the last chart that I do want to look at in terms of gold charts is this weekly chart that we've now converted into a Japanese average chart. The difference, of course, between a Japanese average chart and a standard candlestick chart is the Japanese average bases the open on the midpoint of the prior candle. So whenever you look at this, you're going to see it opens at the midpoint of the prior candle. Now, what we look for in this type of a chart is twofold. The first thing is we want to see an absence of upper wicks or tails. The reason for that is the statement it makes by having these bald tops, so to speak, is the fact that each week, at no point during that week did it trade above the midpoint of the prior week. That's what would give you a upside tail or wick. We also, secondly, want to look at the size of the candle, because a Japanese average chart is always going to lag behind the movements that we see in a standard candlestick or bar chart. However, what it will give us is a clear indication of the strength or lack of strength of a current trend. Now, based upon that, what you can see is you're looking at candle size. And what you're looking to see is, for example, as a market moves up, you want to see when that trend begins to wane. And the way you'll see it is the candle size will begin to get smaller than the previous weeks until you get almost a doji-like candle, and then you will get your turnaround or your basic color flip. In this case, as we look at this market, we've got a clear downtrend, and it does appear as though that trend is absolutely still intact. Silver also closed higher on the day and substantially lower on the week, especially with yesterday's dynamic drawdown. We'll definitely want to take a look at that. But we did see price gains of over 1%, almost 1.2%, as silver closed up roughly 19 cents higher at $16.14. Of course, today's upside move of approximately 19 cents could nowhere compensate for the dramatic drawdown in silver yesterday, in which we saw it lose about 7% of its value. You can see that in regards to a long red line. And we'll come back to this daily chart in a second, but first let's take a look at the action this week. And of course, when we do that, we can see the relative losses that we saw in terms of value in silver this week, this representing our weekly candle. Most importantly, we have been talking about the fact over this last week that silver has truly been reacting differently than gold, in that as the market came down, gold had 6 consecutive weeks of lower pricing, whereas here is the presidential election last month. We got 3 consecutive weeks of lower pricing in silver, and then 2 weeks of higher pricing, followed by this week a return to lower pricing. So we have certainly seen this market trading to a different drummer than gold per se. And that key distinction can certainly be seen on this daily candlestick chart of silver, because what we're seeing is that although the market bottomed, we did get the market finding support at a 61% retracement, which gold did not, and then trading higher and really creating almost an upward moving channel. That, of course, was taken out yesterday as this market dramatically broke below support of this market, which sits roughly at about 1630. We're at 1650, and I believe that now this channel line is really alluding to resistance in silver as opposed to support. The US dollar, although trading in essence unchanged, slightly lower on the day, did close brilliantly higher, another incredible performance, taking it to a 13 or 14-year high. Dollar well above 102 at 102.86, but it is off of the highs that it reached this week. We'll certainly want to take a long-term look and a historical look, the historical perspective, so to speak, of the US dollar today. The dramatic increase in value of the US dollar continues, as we saw a high this week exceed 103. And in terms of a historical perspective, we saw the US dollar trade to a high not seen since really December of 2002. That would be this particular bar right here. And of course, that matches up with this current high that we witnessed this week. The one thing that we really need to put into context when we start talking about the fact that the dollar is at a 13 or 14-year high is the fact of where the dollar was at. Because one thing you've got to take into account is that the dollar had gone as high as above 120 on the dollar index, and what we are comparing it to is really a free-falling market and comparing it to a point in time in which the market was continuing to fall. In other words, the fact of the matter is, to find a technical level of resistance, we have to look at some of these top areas where the market stalled, and you really don't have any technical resistance in the US dollar really till about 105, and then another major level of resistance that would come in at around 112. My reason for bringing this up and looking at the dollar index this way is that it indicates, at least on a technical basis, that we certainly have more room potentially on the upside for the US dollar to move. Although equities closed modestly lower today, as you can see reflected by the Dow Jones Industrial Average, closing off about 8 points at 19,843. There is absolutely no doubt we closed at a new record high this week on our weekly charts, both in the Dow Jones Industrial Average as well as the Standard & Poor's 500. All three indices, meaning the NASDAQ also, moved to new record highs throughout this week, and we are now in our sixth consecutive week of higher equity prices, higher US dollar, and lower precious metals pricing. And the dynamic climb and the record prices that we are at in U.S. equities can clearly be seen when we look at this weekly chart. We can see that since the election was held November the 8th last month, which represents this particular bar right here, we have seen this market move from approximately 18,000 to approximately 20,000. We are within striking distance at this point of that elusive number. And we could certainly see the market move to or above 20,000 by the end of the year. And this dramatic climb is even more clearly illustrated, I believe, by looking at a monthly chart. Although it's not something we would trade off of, we can clearly see that over the last 2 months, represented by these two bars, we have seen this market move roughly 2,000 points. We can also see how dramatic the climb has been since really the beginning of 2009, in which we saw this market move from what? Roughly 6,500 to about 18,000. That tremendous swing, a couple of real gyrations in the market, of course, this at the end of last year and beginning of this year, as concerns about China and other issues that came in. I believe this was the Brexit vote right here, but we've had a couple of deep retracements in the market, but nonetheless, we are in uncharted territory at this point as we quickly approach 20,000 on the Dow. My sense is that this market is driven by optimism that is based upon promises. Until the point in time in which those promises have to be put to paper, pen to paper, so to speak, I believe this optimism could, in fact, continue. There is absolutely no doubt this has been a most interesting week when we look at global events that have really moved these markets. Although the Dow Jones Industrial Average did close slightly lower on the day, it did close this week at a new record, or new all-time record high. Precious metals continue a dramatic decline, with gold losing approximately 2% this week. And for the sixth consecutive week, trading lower and losing over $200 since the presidential elections were held last month. Now, the key, as far as I'm concerned, is the fact that this optimism, which has fueled current market sentiment of a higher U.S. equities pricing, higher U.S. dollar, and lower precious metals, is based upon a short-term optimism that President-elect Donald Trump will be able to effectively implement these programs and policies he has spoken about since the presidential election and during his campaign. Whether or not he can actually implement and move this talk into action, so to speak, will determine where the markets move next year. My sense is, all things being equal, and as long as we don't have some major economic or geopolitical glitch in the marketplace, we should see these current trends continue throughout the end of the year as we go into our holiday season next week. This has been Gary Wagner, wishing you, as always, good trading, and we'll talk to you on Monday for another daily update and review. Bye-bye.